So we are going to do some financial analysis study today. We'll pick up on F2 where we left off yesterday. And the first thing we're going to cover is something you probably all had in college, net present value. And we cover net present value and internal rate of return at the same time because they're the inverse of one another. This is the formula. And you're solving for the present, the dollar amount. Same formula down here, you're just solving for the interest rate. So let's go take a look at a spreadsheet that we have. So what you can see here in the way it works, here's your cash flows. Here's your initial outlay is $100,000, and your cash flow, let's call it profit, for each of the next 5 years. So the way the formula works is it's cash, so $5,000 divided by 1 plus the interest rate. We're using a 3% interest rate here. So 1 plus R, so 1.03 will give you 4,800. And then in year 2, you do 1.03 squared, and you divide that cash by that, and you get that, and 0. And then you cube it, and you quadruple it, and quintuple it, and whatever. And that's how the formula does, and it just adds them all up. And you come up with 11,386. This is some more elaboration on the formula and the R factors down below. But you can just use this formula. That is the Excel version of NPV. And you'll see that the two answers are the same. So IRR, you use this IRR formula. And what it does is it just iterates until it finds the interest rate that gives you that net present value. So you would know what your cash outlays are, and you would know what you end up with, and you'd solve for the interest rate. There's also one called payback. And all that is you take your initial investment and then you get an average cash flow. Basically, you divide that by 4 years minus 1, and then divide by this. Anyway, it tells you how many years it's going to take to pay back this $100,000 based on these cash flows. We use IRR mostly to rank projects. The problem with IRR is these cash flows. These are assumptions. It's looking down the future saying, I think I'll make this much. This is probably usually known, the outlay. But if my IRR is too low, I just need to kind of goose these assumptions up a little bit, and I got a better IRR. Magic. That's the one drawback to IRR, but we use it a lot for ranking potential projects. Okay, now we've got return on investment, ROI. This is a very common one too. Annual operating income divided by total capital invested. So for a particular project though, it's going to be the net present value of the cash flows that we just looked at divided by the total capital invested. So the ROI would be that 11,000 divided by the 100,000, or about 11%. And then you've got a simplified ROI where you don't do the net present value mess, because that's usually a little overboard. You just say, if I got $1,000 invested and I earned $1,250 off of that 1,000, I got to gain a $250 divide by 1,000, and then I got 25% ROI. This is the way it's usually done. Return on capital invested. measure of how well an organization is in using its capital, All right. I guess we need to separate that out. Is using its capital. It's net present value of cash flows from a project divided by the total capital invested in the project. Very similar to ROI. And then you've got return on assets employed, which would be the net income from the company for the year or the quarter, plus interest expense after taxes, divided by average capital employed. How effectively the company uses its assets, return on assets employed. And then you got return on total assets, net income divided by total assets. Uses how effectively is the company using its entirety of its asset base. Got a few more here. Return on equity. This is a very common one. How efficiently is a company managing the equity that shareholders have contributed? So the shareholders contribute equity to the company or money, and they get paid back in dividends usually. So they want to know how much net income has that money they contributed generated? What kind of percentage is that? And then you've got margin analysis. So gross margin, you'll hear that term a lot. Measures the profitability of a company in relation to its sales. So it's basically cost of goods sold, sales minus cost of goods sold divided by sales. It'll give you a percentage. And it doesn't include taxes and anything below that's not part of the product, but this will tell you your gross margin. If your gross margin is positive on your product, then you've got a good chance of covering everything else. If it's negative, you're probably going out of business. Cash flow. To pay bills, companies need liquid assets. Cash is the most common. So the cash flow statement will tell you how much cash the company has on hand at the end of the time period. It's usually an annual statement. So you'll see this in small companies a lot. They don't have a lot of cash on hand, and they have to take loans out for working capital. The balance sheet. So there's three different statements. You got the income statement. We've been looking at the cash flow statement, and then the balance sheet. Reflection of what the business owns, assets versus what it owes, liabilities, and owner's equity. So assets will equal liabilities plus owner's equity. Working capital, we've talked about a few times. We need this because we have to pay our supply base sooner than we're going to get money from our customers. But you can see how much working capital a company is using by taking the current assets minus the current liabilities on the balance sheet. Anything below 1 indicates negative working capital, which means the current assets are less than the current liabilities, which is not a good position to be in. Anything over 2 means the company's just sitting on cash. Most believe a ratio between 1.2 and 2 is sufficient. Profit and loss, P&L. You'll hear that a lot with us. Income statement, how much money is the company making for the period? Net sales, the sales minus returned goods. Cost of goods sold, cost of the components, labor, and factory overhead to make the goods. So everything that goes into actually making what you're selling. Gross profit is net sales minus COGS. So you got margin, gross margin, which is a percentage, sales minus COGS divided by sales. And then you've got gross profit, which is net sales minus COGS. This is a cash number. The other one's a percentage. Then you've got net income, which is net sales minus the cost of this to make the parts that you sold. Then you've got selling, general, and administrative expenses, which is your salary and purchasing, taxes, and interest. And after you subtract all of that, what's left over is net income. Time value of money, we just looked at that in net present value. it represents the notion that the same amount of money has a different value today than it will in the future, mostly due to inflation. PACCAR Purchasing Controllers Financial Review Database we've looked at yesterday. Suppliers are rated by PACCAR Purchasing Controller on several financial ratios. And I think this is a financial analysis worksheet you can give them. Yeah, it kind of talks about it. Got instructions. Oh, come on. This new Excel just kind of drives me insane. So this is what it looks like. It'll give you all your financial ratios and what they're doing. Yeah, they're all down here. So there you go. Come on. All right. Depreciation. So it's an accounting concept that was invented to more accurately depict what an asset is actually worth at a given point in time. So if we buy a machine or a car and it's brand new, it is recorded on the company's balance sheet at the purchase price. We cannot leave this value on the balance sheet because the machine or car wears out over time, needs repairs, etc. We need a way to reduce the value of the balance sheet over time. Otherwise, we're overstating the company's assets, because we all know that a car won't be worth the same amount in 5 years that it is today. Otherwise, yeah. So how fast we reduce the asset's value is usually up to the company, and cash flow is unaffected by depreciation. So depreciation is just an accounting convention so you don't overstate your assets on the balance sheet. Higher depreciation values reduce net income and thereby tax liability. So they have accelerated depreciation. We'll take a look at some of these. But the reason they do it is because it makes a bigger charge to the income statement and reduces the net income of the company, which thereby reduces the tax liability. So some common methods, some of the years digits, sum up the number of years of the asset's assumed life. So if it's 5, it would be 1 plus 2 plus 3 plus 4 plus 5. And then I'll show you how to divide that out. But front loads depreciation in the early years of an asset's life. Remember that. Front loads depreciation in the early years of an asset's life. Straight line is the simple average for each year of the useful life. Double declining balance is the most aggressive front loading, even more so than some of the years digits. So it wants to match depreciation in the early years against the asset's greater earning power. And then unit of activity is based on production output in each year. So here's some Excel spreadsheets you can play with. That will cover the different types of depreciation, if this thing ever opens up. All right. So here's your asset, here's your salvage value, average life, production per year, total units produced, depreciable value, what's left over after 5 years. Or no, that's 20 minus 2 is 18. That's the depreciable value that you're going to depreciate. So some of the years digits, so you got 5. It's equal to 15. That's 1 plus 2 plus 3 plus 4 plus 5. And then you got 4, and it just clocks down. And these are what you come out with. Double declining balance you're going to say because straight line is 20%, when you divide 3,600, you double that for double declining balance. And then units of activity uses total units produced. So those are your depreciation methods. This is the fastest. This is next fastest. This is more common. It's just straight. And then units of activity is the last one. It's based on the output. All right. What is calculated by subtracting the cost to produce the goods from net sales? What is calculated by subtracting the cost to produce the goods from net sales? So you got a cost to produce the goods and you subtract that from net sales. What do you get? Anybody want to chime in here?
Profit.
What's that?
Profit. Gross profit.
Yeah, gross profit. Yeah. A should be. A it is. All right. So questions 5 through 8 are out there. You guys go ahead and jump on. Raise your hand when you get done. That done. All right, let's go over some answers real quick. Number 5 is Charlie. Dividing the organization's net income by its total assets calculates the return on assets. 6 is Bravo. Simplified ROI compares costs, the investment, and benefits, the return, on a small number of key issues. 7 is also Charlie. To determine the weighted average cost of capital. There's a couple of ways you can do it. But basically, what these guys did was they determined the cost of capital with each of these 3 different types. And then multiplied by each interest rate and added them up. So they did each of the interest rates first and add them up. The other way to do it is to multiply out the dollars and then add up the dollars and then divide it by the total dollars. You get the same answer. And 8 is Charlie. The sum of the year's digits method. So with these guys, you have to kind of remember little catchphrases for each one of these depreciation things. Some of the year's digit, front load depreciation, the early years of the asset's life. They'll use that as the answer. And then they'll use this as the most aggressive form of front loading. And then simple average, straight line, and based on units production. So you kind of got to remember those because that's how they can refer to them. Any questions? All right. We'll finish this up on Monday with all lease analysis. Very exciting stuff. See you
Thanks,
guys.
Rick.
Yeah.
Thanks.
Thank you.